I'm Evan Polaski, Managing Director of Investor Relations here at Ashcroft Capital. And today I have Traci Wilhelm with me, Ashcroft Director of Asset Management. Hi, Traci.
Hi, Evan. How's it going?
It's going well. How are you?
I'm great. Thank
Why
you.
don't you remind our audience a little bit about your background and what you do here at Ashcroft?
Sure. I've been with Ashcroft for almost 2 years now, and have been in the asset management business for multifamily for 13 years. And before that, practiced law and the real estate transaction side. So I've been in the business about too many years to tell on in public.
And in your role in asset management, kind of just very high level, what are some of the things that you're doing day to day?
So we are working hand in hand with the property management team to make sure that all of the business plans that we're underwriting to are being implemented, and also working with any of the new market trends that are happening, anything that's happening at a certain property, to help guide them through solutions to come up with the best one for the business plan of the property.
No, I appreciate that insight, and let's dive into it. So just like we've done in prior quarters, would love to get just a bit of a recap as to how we were performing through Q2 and currently performing with the asset in terms of occupancy, collection, some of those market trends you were just referencing that you're looking into.
So I think first we'll talk about collections. Our collections have actually been really strong, more strong than we've seen in the past year or so. Collections were strong through COVID, as you may remember, but then in 2022, about Q2 of 2022, we started to see collections really taking a dip. And that's really because a lot of the rental assistance programs were ending. And so we started to see a larger number of evictions. Because of that larger number, we weren't the only ones seeing that. The eviction process lengthened across the portfolio. So it took us some time to get a lot of these non-paying residents off of the properties. We've been pretty successful at that across the country, with the exception of Atlanta, which is still very, very slow. And so we've then thus seen the collections really increase over that 1 year period. So we're up about 120 basis points a month on collections. We're at about 96% collected across the portfolio. Most of our properties are in the 98, 99%. We've got a couple that have always been a little bit of lagging in terms of collections, that are still pulling that average down to about 96. But the majority of our property are collecting quite well. In terms of occupancy, we are seeing a softening in the market, and our properties are no exception. So we have underperformed our budget. We've seen CoStar has gone down, anywhere from 1% to 4% in occupancy, depending on a certain submarket. And we've seen our portfolio decrease about 2.5% to 3% in occupancy. Some of that's strategic because we did roll on to revenue management across the portfolio. We still have a few properties to roll on later this summer. But so some of that is strategic decrease in occupancy so that we can push that revenue and push those rents as much as possible. And we're watching with our benchmarking program, we're watching our competitive properties within every submarket to make sure that our goals are in line with what the submarket is achieving. So we're not trying to achieve, for example, 97% occupancy in a market that's sitting at 92, because that means we'll miss out on a lot of revenue. So we're really monitoring a lot of different things, but our occupancies have dropped, but so have all of the others in the market.
And as you've mentioned, as we've talked about in the past, this revenue management software, it's really designed to maximize total revenue, which in some of the properties sitting at 92% may be the actual maximum revenue generation, and ultimately NOI generation for that property, where another market might be, as you know, 95, 96% to keep, and rents are a little bit lower to keep that occupancy higher to, in a grand scheme, or maximize all of that, correct?
That's right. And I think at the bottom line, the goal of the system is to maximize revenue, like you said. And what creates value on our properties is that rent roll increasing. And so it's really focused on increasing the rent roll or maintaining the rent roll in markets as much as possible, in markets where it may be going backwards. We've seen a lot of softening, particularly in Atlanta. And so we are still seeing positive trade outs at a lot of our properties. We have a few that are seeing some negative trade outs, particularly in those with a heavy amount of new supply. So the system is really helping us not overreact to some of those pressures and keeping our rents as high as we can achieve while still achieving a stabilized occupancy. So it's been really beneficial for us. We're really watching it, of course, every day, making sure that it's not doing anything too crazy, but it's really helped us maintain a discipline in terms of our rents throughout this, downward pressure on our properties.
And obviously, as you noted, it's not just our properties. This is really fears of, if not fully stepping into the early stages of a recession. So with that, what are we, or we're seeing some softening? How are we handling that? Kind of what kind of bigger trends are we planning for should we enter a deeper recession?
A few things. I mean, I always say this, the beauty of multifamily is that everyone needs a place to live. So you're not going to have an office phenomenon or commercial real estate phenomenon where you're going to have empty apartment buildings. There's still a housing shortage in the United States. So we know that we may not be seeing as much growth as we've seen in the past. We may even go backwards a little bit in rents on a couple of properties, but we're still going to be positive in terms of NOI. So we have that really solid foundation. And then so what we're doing is we're assessing what is bringing people to our properties and how we can maximize the amount of people coming to our properties so that we can close on them. We've also launched some really interesting technology tools to help us do that, as well as improve collections and retain talent. So we've launched a couple of artificial intelligence technologies that help us follow up on our leads more routinely so that we can free up our team to really have that in-person interaction. We're working on improving our online reputation scores. So because we know that that's really fundamental to retention. So we've launched a lot of initiatives over the last 3 or 4 months in preparation for this downward movement of the market, and so that we can be set up for success even within that. And I was working during the GFC, and so I was seeing a much more tense situation then than we're seeing today. And there's all sorts of moves you can take a look at, but we are starting to really just measure and make sure that we're monitoring how the markets are performing versus our portfolio, to make sure that we're not either missing out on opportunities, maybe exceeding other market indicators too. So there's a couple properties where it may seem soft to us because that property's been at 96 for the last 2 years, but it's at 94 today and the market's at 92. So we feel really good about where we are. So sometimes it's just support for where we are. And then sometimes it's really just understanding the bigger picture to understand. But I think, so aside from those technologies to really bring people in, we've also really focused our efforts on stopping unqualified residents from getting onto our properties. I think we mentioned this maybe last call, but we implemented a technology called Snapped, and that has been really successful. So since inception, on our whole portfolio, we rolled it out in January of this year. So since inception, we've caught 375 fraudulent applications, which is about 10% of our applications. So that means 10% of the people who've applied have done so fraudulently. And without this technology, we may have only caught a certain amount of them, the ones that were very obvious. So as a reminder, this is the software that detects digital alterations into your bank statements and pay stubs. So it's been really beneficial for us. And so we're implementing tools like that along the way to stop kind of the bleeding of the bad debt on the front end, so that we are only really getting truly qualified candidates in the door. And so I think that we're going to continue to see that as a really huge factor as people are getting evicted. Like we talked about, now they have an eviction on their record, so they're going out and purchasing fraudulent documentation to perhaps be accepted.
Yeah, and as you noted, we have been seeing it, probably, it sounds like from prior conversations, more on the financial statement side. Hey, I don't actually earn as much as I'm telling you I earn, so I can qualify. But with, increases in evictions and turnover, people might be using it on the background side as best as they can, because I'm sure we still run background checks on everybody ourselves, which hopefully there's no technology to to amend those. But no, I appreciate that. And kind of what are we seeing, speaking of tenants and trying to ever improve that, what kind of trends are we seeing from those tenants?
I would say a couple of things. I think we are starting to see residents be a little bit more price sensitive. So, which I think is understandable. Everybody's a little unsure of what's going to be happening. So we are starting to see a moderation in renewal rates, although we're still getting really great trade outs on our renewals overall. We're starting to see the need to be a little bit softer on those in order to maintain our occupancy. And gone are the days of the 16 to 40% rent increases on renewals, but we're still sending out some that are above 10%, but the majority of them are closer to that 7-8% range that are bringing them up to market. So I would say that sensitivity is on both on the front end of leasing and as well as the renewals. And then I would also say that an interesting shift is that we're starting to see and feel a lot of people leaving for home purchases. And it seems kind of a little counterintuitive, but I think they've been waiting so long because waiting for the prices to come down, and they've been waiting, and the prices haven't come down as much as they wanted, but it's their time and they've just decided to go ahead and act. And so I think those are kind of the two big trends that we're seeing. We haven't seen a lot of the big trends that were happening during the GFC. We haven't seen a lot of people going from a 1-bedroom to a 2-bedroom and getting a roommate yet. We're tracking that, and we're starting to see some movement there, but it's really going both ways right now. So we are tracking it. We'll watch it because that was one of the big indicators in the GFC that our residents at the time were hurting.
Again, obviously a roommate helps you split the cost. So, not knowing the data, that was one thing I was kind of thinking about. Are we starting to see more demand for 2 bedrooms with a roommate, or a shift in demand for those 2 bedrooms with a roommate, where in the pandemic it was, I wanted a 2-bedroom because I need a home office and I don't want it to be in my bedroom. So just
I think there's a little bit of price sense. It's to be determined, I think, yeah. But I think there's that price sensitivity will play into that, where people will either say, okay, it's just me, I'm going to take the 1-bedroom, or they're going to say, okay, well, I still want the extra space, the bigger living room, the bigger kitchen, but I need a roommate in order to afford it. So we're watching those trends, and I think we'll see a little bit more and know a little bit more after the next quarter.
No, I appreciate that. And now kind of shifting pace, because a lot of this seemed to be on the leasing, tenant side. On the operations side, how are we doing with expenses? Because we're at a big part of the overall NOI.
So I'm not sure if we've talked about it on this call before, but I think the big impact that we've seen is in our insurance, and that's an industry-wide issue. I think at a conference I was at recently, they said that one of the big top 4 management companies or owners in the country said they've seen 5 years of double-digit increases. We did see a very large increase in our portfolio this year. However, last year we had 0% increase, so it really feels bigger than it really is if you look at it over a 2-year period. But that, I think, is probably the biggest impact. And what's interesting about that, and I am not an insurance expert, but there are a lot of people that are struggling, that have policies expiring now, that are struggling to even get coverage, particularly in Florida, because there are so few people in this market. So one of the things that we're really hoping for this year is a year without hurricanes, a year without any big name storms and any major catastrophic losses for the insurance company, because what the prognosticators are saying is if we have that, a lot more people will come into the market, which should bring pricing down a little bit, or at least keep it flat. So that's our optimistic hope for 2024. But I think that's a big piece of it. We actually have seen payroll has been increasing. We budgeted appropriately, so we are within our 2023 budget right now. But we have seen payrolls pretty dramatically increasing over the last couple of years. And part of that is because there's so much supply delivering in our markets. So let's take Atlanta, for example. You've got 30,000 units that are being supplied in Atlanta over the next year. That's let's just say 100 properties, 300 units of property. So you've got 100 properties now that need a staff of 10 people. And where are all those people coming from? You can't generate them out of, midair. So they're starting to pluck them from other properties. So in order to keep your really talented people, you're having to match the pay. And in a lease up, they don't care how much they pay someone. So it's especially for a merchant builder. So it's been really a challenge for us. And I think this year will be a challenge that in order for us to retain people, we're going to have to be willing to increase their pay a little bit to be competitive. Obviously, all of the culture things that we do can provide a really great benefit. But at the end of the day, a lot of times it comes down to the pay. So we're monitoring that. Again, we budgeted appropriately for that. We budgeted for fairly large increases this year, even though we didn't give that large of a raise because we knew that some of this would be coming. So we're within, like I said, we're within budget, but I will say from an underwriting perspective, we are certainly over our underwriting expectations because I think we've seen an increase in the industry of something. I think payrolls, I don't know what the latest statistic is, but I looked at it about 6 months ago and it was something multifamily increases were like 14-15% versus, 5-6% in the general economy. So I think, we are starting to see that competition come through, but we planned for it and budgeted appropriately for it.
As you noted, from an underwriting perspective, it probably has an outsized impact looking back at the deals we may have bought in 2018, 2019.
That's right.
Where now we can kind of control it, but thankfully also those 2018 and 19 deals benefited from, as you mentioned, 16 to 18 to 40% occasionally renewal increases that we never underwrote for. So again, that's the joy of underwriting conservatively. If you don't have to hit the mark on everything, the net result tends to start balancing it out.
The one other thing, sorry, Evan, the one other thing I would say is that we're really watching taxes because you're hearing a lot in the news about taxes. Some of it positive, in Texas, there's some legislation that could actually positively impact us by really stopping the growth on taxes. And it's really meant for single family, but it would impact us as well. So I think that there's some positive things there. But we're watching that, and our tax consultant our initial assessments were quite high this year in Texas, but our consultant has been very successful at getting those down. So we don't expect anything different this year. And in Georgia, we are all frozen on our taxes for 2024. So we're very protected in Georgia for the next year. So we'll be flat to this year in our taxes next year. So we work hard on the taxes, and we've been really successful at keeping those to moderate levels.
No, I appreciate that. And I know last time we were talking about some of the efficiencies on other line items, the tenant or the unit turns by providing our maintenance staff with sprayers so that we don't have to respray and hire an outside contractor to repaint an entire unit just to touch up a few spots. How are those types of expenses, what I'd call more of the controllable side, how are those tracking?
Those are tracking well. I would say that we've rolled out a purchase order program. It's a little bit of a manual process now while we implement the new technology, which is a pretty big undertaking. But part of that technology is really great because our maintenance teams will have a catalog to order from. So we'll know exactly what they're paying for every part because that's the only way they can buy it. And so all of our vendors will agree to be in this catalog, agree to the pricing. And so it's a really great way to really control those expenses. So we're in the process of getting that rolled out. But in the meantime, we're operating under a manual purchase order process where the asset management team is actually approving any expenses that will be over budget. And then the SVP of operations from the Birchstone team is approving anything that's within 75% of budget, so that we can sometimes you have to go over budget on an individual line item, of course, but that way we're at least monitoring it to make sure that the expense is warranted. We can ask questions. Is there another way to do this? But all of these programs are really intended to try to tighten that expense growth as much as we can, fighting the inflation that everyone is seeing.
I appreciate that, and yeah, it's as you own roughly 13,000 units, give or take, and you have 400 employees. There are certain systems that used to work that need to be, revised as we continue to scale. So I'd love hearing some of those details. And finally, I would just love to hear sort of the changes, kind of what we're doing, whether it be some of the details of the leasing, the maintenance side, or even up to the asset management side to just continue to drive value in our portfolio in this uncertain economic time.
So I think that we've talked a lot about the things that we are doing, some of these steps. I think technology is going to play a huge role in this for us, and not only in the purchase order sector that we were just talking about in controlling expenses, but also on the leasing side as well. Like I mentioned, the leasing AI tool and the collections AI tool that we're rolling out and testing. I think that the other big thing is we've always focused on customer service, but we're really starting to hone in. We launched a system called J Turner Research, which has Aura scores, which are online reputation assessments. And so this is something that the industry really measures and uses. And so now that we have this really great tracking mechanism, we are able to come up with action plans and effectuate actions that will improve those scores, because we know that going into a softer market, retention is very, very important. So we know that these customer service initiatives are even more important than we've always given them credence before. So we're really working on fine-tuning that, making sure that our residents feel a connection with our teams and with each other on each site. So we're evaluating lots of programs, but these customer service action plans that the teams are providing are really how do we improve, even at the properties where they have some of the highest scores in the country, in industry wide. It's how can we still improve that feeling, even if the residents are really happy? How can we make it even that much better so that when we do give them a 5% renewal increase in a market where nobody else is getting increases, that they want to stay despite that. So that's really ultimately the goal, and that will drive the positive revenue at the end of the day.
I appreciate it. Yeah, we're seeing it on the investor relations side. It's always just, keep your current customers happy, whether those customers are our investors or they're our clients, our tenants or residents. And, it just tends to be a win-win. So no, I greatly appreciate all your time and insights as always, Traci, and thank you so much for joining me tonight.
Absolutely. Thanks, Evan.